Good morning and welcome to Blain's Morning Porridge. It's February the 10th, 2026. This morning, bond market alarm bells are sounding. Yes, it's the closest I've got to a bell, and you might be familiar with the sound from the Olympics. Anyway, this morning, let's start off with a quote. Feche vache, classic Monty Python, just before King Arthur says, "Run away, run away, run away." Now, did somebody say century bond yesterday? What's not to like about the bond market? Rates are going to fall, everyone wants to buy credit at historically tight spreads, and the biggest, most successful firms on the planet are offering to pay you 70 cents over Treasuries for your money. What could possibly go wrong? Yesterday, someone said 100-year sterling bonds from Google. Wow, that's interesting. Ding, 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 bond market alarms going off very loudly in my head. What do the buyers of that century bond know that we don't? There are so many reasons not to buy a corporate century bond, but clearly there is demand for them, otherwise Google wouldn't be selling them. I'll come back to 100-year bonds later, but the succession of massive public and private credit AI hyperscale debt deals to fund the data center build-out has my bond spidey-senses on edge. Google's century bonds yesterday sent them into overdrive. The sheer volume of debt being raised for AI is off the historical scale. There are estimates of 700 to 900 billion of funding to be raised by the hyperscalers building the data centers this year. Google raised 20 billion of its announced 185 billion 2026 funding ask yesterday. Oracle attracted a staggering 130 billion book on its recent $25 billion deal, despite many market analysts, including myself, fearful of its weak financials, its overstretched direct debt profile, and its over-reliance on OpenAI being able to pay the leases on all that compute. Amazon and Microsoft are also in the market funding as much as they possibly can. Now, some say that $3 trillion of debt will be raised over the next 5 years to plow into the AI data center space. That's extraordinary, but apparently it's not a problem because these are some of America's largest and most successful companies. So what can possibly go wrong? And why did Enron, WorldCom, WAMU, and the big three auto companies, Ford, GM, and Chrysler, just flash through my memory? Oh, because they've all defaulted in the past. Recently, I've written about the potential of what we call a corporate credit bond burp. Not necessarily a complete credit meltdown, but a market that's gotten so ahead of itself that it's about to suffer from chronic indigestion. The burp is the warning that it's all about to happen, that the underlying assumptions behind a trade or a wider rally were misfounded, and reasons for suspecting a bond burp is imminent because of AI include all the circularity financing arguments about AI firms funding and backing each other through data center leases and compute, and the historically tight credit spreads in the corporate markets, which raise multiple questions about what is supporting what in the very complex debt ecosystem. Should I be worried? Well, corporate bond buyers are not daft. They are not equity stock pickers given to flights of financial fancy inspired by overly rosy narratives that CEOs like to spin. Fixed income analysts are intensely analytical and they want to know exactly how they will be repaid interest and principal. That's really all they care about. They want dull, boring, and predictable cash flows to back up their analysis. They don't like whoosh and they don't like surprises. Every detail of how funds will flow to the debt provider will be intensely scrutinized on bespoke private credit deals, especially on the kind of complex data center leasing deals that were occurring off balance sheet, where the analysts drill down through each and every tenant's particular risks. Certainty is the objective. And if you want to have fun at any financial market party, Avoid the bond guys. Go and play with the equity salesmen. They're always a hoot. But when very, very clever people in the bond markets start to get excitable, well, that's when you need to get very worried indeed. For all their care and caution, historically, bond buyers do get it wrong. And I've seen that repeatedly throughout my career, starting with the great perpetual bond market crash of 1986, when I was but a youngster on the floor of Morgan Stanley, right the way through to CDOs and RMBS tremblers that set off the global financial crisis that began in 2007, the consequences of which are still with us today. And there are parallels between 2006, just before that crisis, and today. The risks may be very different, but what's driving the exuberant excitement is the same, the expectation that nothing's going to go wrong. There are all kinds of risks swirling around the current AI bubble, and some of them are in such plain sight they might be getting missed. When analysts are so focused on the fine detail of deal, it's easy for them to miss the elephant hiding in the fridge. You can tell he's there by the footprints in the butter. The data center build-out and associated energy infrastructure that will be required to make all kinds of AI work generate a whole series of assumptions, such as steady growth in demand. Yet the technology looks like it's going to remain pretty much the same, and that cheaper, better, less energy intensive ways of getting to the same place won't occur. I don't buy that. AI is intensely competitive. It's always going to be spurring new tech and new innovation, and we have new methods of computing like quantum coming. While the USA is chasing large language models, China has gone down the much cheaper, smaller language model, open weight AI route. How many is too many data centers? If AI starts closing down software companies, then how will that impact total demand for AI? How vulnerable could the current leases on data centers be to a cascading series of lease renegotiations? At which point I'd ask if you ever came across a company called WeWork, because that'll tell you what happens. The credit market is a very complex beast. In recent days, the software as a service market has taken a massive tumble on fears that Anthropic's latest AI products will simply push software businesses out. As a result, these firms' bonds have been marked down and debt deals in the pipeline have been stalled. Suddenly, these software firms are reining back on their commitments, including their own compute spending, with credit investors looking to hedge the rising risks of credit losses on these names. The result is a thin but definite shift in risk appetites. Which leads to, where would you invest instead? Do you invest more in AI as the future, or is AI actually the problem? You need to know you're looking at the right thing, and it reminds me of a story from World War II, the B-17 Flying Fortress bomber. The Germans were shooting lots of them down, and American engineers looked at the battle damage on the ones that struggled back home to their airfields in England and analysed the bullet holes. They looked, they drew charts, and they concluded that the planes needed more armour where the holes were most concentrated, as that's where the Germans were hitting the aircraft. One young analyst said, no, look at where there is no damage. The ones coming home show where the damage is not critical. So they re-examined the planes and spotted very few planes came back with holes around the cockpit, the engines, and the rear fuselage. They strengthened these areas and the number of aircraft lost fell. The tails stopped being shot off, and putting a new chin turret on the nose reduced head-on attacks, which had been killing the cockpit crew. Think about the bond market in the same thing. It's not what you can see, it's what you can't see that you need to be looking for. So what do we need to be looking at in the current bond market? Well, we know there's plenty of liquidity feeding the bond market, and that's because the expectation is Donald Trump will get his way and interest rates are going to fall. And we know that Scotty Bessent, head of the US Treasury, wants bond yields to fall so he can reduce the amount of money the US Treasury is paying in interest on its bonds and bills. And we know that although new Fed chair designate Kevin Warsh was anti-quantitative easing, the only way to get yields lower will be through yield curve control, which is QE by another name, to pull down interest rates. Now, when all that happened back in 2010, it triggered a massive rally in all financial assets, including the credit market. But back then, there was no inflationary spark in the markets following the 2008 global financial crisis. But now there is clear inflationary sparks. And if all the above things happen, then the likely outcome of interest rates being too low will be inflation. That's the bond market's worst nightmare. Who wants to hold debt when inflation is eating into it? Anyway, I did say I'd look at 100-year bonds. There is a buyer base for ultra-long bonds from insurance and pension funds who have long-term liabilities, but it's a kind of small market. It could be that other people are coming in because buyers like duration. That's a measure of how sensitive bonds are to changes in rates, which is magnified in longer dated bonds. And one of the great stories there is the Austrian century bond, which has traded over an enormous range because of that duration. As a credit play, there are multiple reasons not to buy 100-year corporate bonds. Even AAA borrowers do default, and that cumulative risk of default rises over time. Now, for AAA, that risk is very small. It's, according to the rating agencies, it's less than 1% over 100 years. But AAA borrowers do default because their credit rating deteriorates, and the risk is even worse for credit issuers. They are more prone to hostile acquisitions, their products being superseded, and unlike sovereigns, they don't own the printing presses to print their own money. Few corporates survive 100 years in good shape, and if you are buying Google because you expect repaid in 100 years, well, good luck to you. Corporates rise and fall, and as they do, the chance of default increases exponentially. And if you want more on this, I'd recommend Moody's. They publish very good tables showing cumulative default rates. Anyway, out of time and back to my day job. And does anyone want to fund me to build a data center? I'll be back tomorrow with more Morning Porridge. In the meantime, you can find the Morning Porridge on www.morningporridge.com, where you can get it freshly delivered to your email if you sign up. Anyway, thank you all very much for your attention. Back again tomorrow.